So credit balances which are provided to us will fall under either one of these categories that are given under capital and liabilities. Okay. So first of all, you have share capital that is given. Clearly it goes under schedule 1, that is your capital. Alright, this one is the easiest. So you have to identify these different items and what different schedules they are going to go under. Okay, so schedule 1, statutory reserves, these are balances of all the reserve. Just like how in the problem of profit and loss account, we used to calculate how much of the profits will be transferred to the statutory reserve, isn't it? Now over here in the balance sheet, we will be given the balances of all the statutory reserve transfers that have been done over the years, like how much statutory reserve we have. Okay, and that will go under your reserves and surplus. Of course, current year's reserves and surplus or current year's statutory reserve transfer, we are going to calculate it. So I'll just put an asterisk here, so we know we have to calculate an adjustment. All right. Next, we have profits given of the year, current year, as well as profit and loss account balance brought forward from the previous year. This will go in a working note where we will calculate how much of this profit has been transferred to the statutory reserve this year and how much balance goes to or is carried forward next year. Next, fixed deposit accounts. Can you tell me which schedule this will go under?
Deposits 3.
Deposits, very good. 3. Same way, saving deposit account also under deposits, 3. Okay. What about current accounts? What about current accounts? Current accounts, like I just told you, they are also deposits, because people are keeping that money with the bank, isn't it? The business people, they have this current account opened in that bank and they are depositing money every day. Whatever the amount of cash they make in the business, that is brought and deposited in that current account, right? Of course, that overdrawing facility is there, but they are also depositing over there. So even if the word deposit is not mentioned, understand that any type of money kept by clients, kept by customers with the bank is a type of deposit. Next is bills payable. This will be schedule 5, other liabilities and provisions, and borrowings from other banks, that is money that is taken from other banks, is going to be which schedule?
4.
Yes, borrowings will be schedule 4. Right, amount taken from other banks. So this way you need to identify which are loans given, which are loans taken, accordingly decide whether they go in liabilities and assets. When it's clearly mentioned which are credit and debit balances, it's very easy for you to accordingly bifurcate it and put it in the respective schedules. Okay. Now, there are some adjustments given and you're provided with where or those amounts that will fall under those adjustments. Okay. So you have bills for collection 18 lakh 10,000. Of course, you have to delete uh, the one in thousands. You have to show the reduced amount. Okay. Now this is in lakhs. These all are in lakhs. So you'll have to reduce it further. So if it is 18 lakh, it will be written as 18.1 lakh. Fine. You have to reduce it by those many digits. So this is of course going to the balance sheet over here with no schedule number, but it is additional information. Right. Then there is acceptance and endorsements of 14.12, and there is claims against the bank not acknowledged as debts, which is 55,000. Okay. So this will be, if you reduce it in lakhs, it is 14.12, and this if you reduce it in lakh, it will be 0.55. Now where do these go? Both of these will go under contingent liabilities. Okay. Now what are contingent liabilities? Bills for collection, we already know, any bills of exchange that are there with the bank. Okay. They are neither assets, they are neither liabilities, but those bills are there that are yet to be matured, or they are yet, the bank is yet to recover the money. Okay. Now this amount, acceptances, endorsements, claims not acknowledged as debts. There are certain amounts sometimes with any business, not just banks, which have not yet become liabilities. Okay. Like say for example, there are claims against the bank which are not yet acknowledged as debts, right. So what's happening here is, there is somebody who has made a claim that they want that money from the bank, or they want to take that money from the bank, but as of now that liability has still not occurred. Maybe there is a dispute, maybe there is a court case going on related to whether that money should be paid or not. Like say for example, a person had invested in the fixed deposit, or person had invested in the PPF account, all right, and that account has lapsed or something has gone wrong with it, and the bank is now liable to pay the customer. Say there is a court case going on, or there is any other type of dispute going on. So as of now, we do not know whether the bank has to pay that person or not. That liability has not arisen because the court has not given its decision, let's say. Okay, and only when the decision is made, the bank will know whether it is a liability. So that is how contingent liabilities are to be shown. Contingent liabilities are liabilities which may or may not arise in the future, which you may or may not have to pay at some point of time. Okay. Similarly, you have acceptances, endorsements. These are again related to bills of exchange, promissory notes that the bank has accepted, but it doesn't know whether the money is going to come back or not. All right, whether the person is going to pay the money or not on those bills of exchange. So that is how we are going to deal with this problem. All of these amounts accordingly will go under these schedules the way we have marked them. Okay, and then this is the balance sheet pro forma where we are going to add or post all of these amounts accordingly.